Good morning. The GIFT Nifty is suggesting that the relief rally that we had yesterday is likely to persist and continue. So 50 points up right now on the GIFT Nifty. The question is, can we conquer yesterday's intraday high of 23,137 and then hit higher towards resistance levels of 23,300? That would be the key to track. But for now, let's get to individual stocks. Our research team is standing by with our list of the top stocks for the day. Good morning, boys. So let's start with Sudarshan on Bajaj Auto.
Good morning, Rima. So it's a margin-led beat like TVS Motor. Bajaj Auto has also reported a healthy set of earnings and margin has come in at 20.2%. There was an expectation that margin may slip below 20%, but it's above 20% for 6 straight quarters. And some of the positive factors that have worked for the company: first, demand remains healthy in 125cc plus segment. Raw material cost seems to have stabilized. Second, favorable currency environment also has helped margin. And third, despite the EV expansion that companies has been taking, it continues to maintain the market share in the ICE segment as well. But there are some of the negative factors as well. First, KTM exports were lower because KTM has been facing certain issues overseas. Third, demand remains a concern in the entry-level segment. Nigeria demand has been steady. Company continues to do the selling of 35,000 units per month, but it's much below the peak level that company had seen. And pricing concerns both in the EV segment. Company has taken certain price reductions in certain areas like UP and Bihar. On the numbers front, EBITDA has increased by 6%. Margin remains flat YOY. It has come at 20.2% versus 20.1%. Outlook is healthy. Company expects exports to grow by more than 20%. Domestic motorcycle growth that was at 6% as of H1 FY25. Company says it's likely to see a growth in the range of 6 to 8%. And that growth range would be for the industry. So on the earnings front, it's a steady set of earnings and outlook is healthy as well for Bajaj Auto.
I believe the EV business has also turned EBITDA positive in Q3, aided to some extent by the PLI benefits. We have the management joining in at 9:30 a.m. to discuss the Q3 numbers. But over now to Vivek for JSW Energy. Vivek.
Well, good morning. That's right. So JSW Energy, muted said as far as Q3 was concerned, but one thing to note is that the company has, or the stock has seen a very sharp sell-off, so that may limit the downside, but overall a muted quarter as far as JSW is concerned. Revenue is down by almost 5.5% on a year-on-year basis. EBITDA down almost 17.5%. This on the back of the fact that the company that has a significant portion of its energy capacity that it sells on the merchant market or which is not tied through long-term PPAs actually witnessed some amount of compression as far as spreads was concerned, given the fact that DAM, that is the day-ahead market prices or the spot prices, were down almost 26% on a year-on-year basis. This impacted the company's margins as well as the spreads. On the back of that, margins this time around 38% and profitability down almost 32% on a year-on-year basis. Company is looking to raise close to 3,000 crore via an NCD issue. And also remember, the company actually saw its wind capacity start, but this is a seasonally weak quarter as far as wind energy was concerned, and that also impacted the earnings. What is it that we need to watch out for? The first thing, remember, there was a significant sell-off in the stock price. This is after CERC rejected the company's BESS project, battery energy storage project tariffs. And now the company has gone ahead and appealed this particular tariff order that was passed by CERC, and this particular hearing at APTEL is scheduled on Feb 6. That's an important trigger as far as JSW Energy is concerned. Expect some pressure on the stock today.
Okay, all right, some pressure on JSW Energy. Thanks for that, Vivek. Let's go back to Sudarshan. Sudarshan, tell us about MGL.
So like IGL, MGL has also reported earnings that are better than estimated. It's a volume-led beat. Volumes are up 2% sequentially, and on YOY, it's up 12% year-on-year. EBITDA is down 21% sequentially, but it's much higher than our estimate of 285 crore. It has come in at 314 crore. Margin also has come in at almost at 18% against our estimate of 16.3%. Volumes have come in at 4.12 MMSCMD versus our estimate of 4.07. And EBITDA per SCM, that is one of the important parameter, it has come in at rupees 8.30 versus our poll of 7.40. But beyond the earnings, what would be in the focus? What does company say on the pricing front if company is planning to take any price hike? And second, what is the update on the APM gas allocation if company has got certain assurance from the government? But I'm going with green because of the earnings.
Okay, all right. So thank you very much for that. Well, we have GMR Airports, which should be in focus, and Suzlon on the back of earnings as well. Vivek has got both. Vivek, morning.
Well, good morning. Much better results both from GMR as well as Suzlon. So first, let's start off with GMR Airports. Revenues higher by almost 19%, largely led by higher aircraft as well as higher passenger growth in the quarter gone by. EBITDA higher by almost 48%, margins coming in at 37.4%, a strong expansion as far as margins were concerned. Profitability at 202 crore versus a loss seen last time around. But remember, there is a one-time 410 crore impact as far as profitability is concerned. This is a positive impact that the company has recognized. This is on account of disposal of stake in the Cebu airport. Also remember an important development, Hyderabad airport has actually announced a dividend for the first time since 2019. One worry is the fact that net debt has actually inched up on a year-on-year basis, up 17%. But overall, a strong set of from GMR airports. On the other hand, Suzlon, remember the company had guided for a much better H2 in terms of execution, and the company has delivered. Revenues higher by 91%. This was aided by net volumes or net execution coming in at 447 megawatt versus just around 170 megawatt on a year-on-year basis. EBITDA has doubled on a year-on-year basis, close to 500 crore. Margins at 16.8%. Profitability higher by 91%. Order book continues to remain very strong at 5.5 gigawatt. Now both CNI as well as PNU actually contribute close to 80% of the total order book. Company has also mentioned that they look and evaluate further inorganic growth opportunities.
Thank you very much for that. And at 9:50 a.m. today, we'll have the top management, the CFO of the company, joining in to detail the way forward. But it's back to Abhishek now for SBI Cards and M&M Financial.
Well, to begin with SBI card, it's like Maruti ad, credit cost woes doesn't seem to get over. So 14-quarter high credit cost of 9.4% versus 9% in the previous quarter. For 24 quarters in a row, their annualized credit cost on a quarterly basis has been north of 4.5%. The net interest margin continued to remain on the lower side. It was at 10.6%, which is perhaps one of the lowest that you are seeing in last 19 quarters. Revolver rate has improved this time around to 24% versus 23% in the previous quarter. However, the return ratios, that is ROA, is at multi-quarter low of 2.4% versus 2.7% in the previous quarter. The PAT has declined by more than 30% YOY and more than 5% sequentially, and much below many analyst estimate like Motilal Oswal and Nuvama as well. M&M Finance, the loan growth has come in at 19.5% YOY and a decline of 0.7% sequentially. So YOY, the loan growth is one of the lowest that you are seeing in last 10 quarters. The gross NPA ratio is the highest in last 4 quarters, coming in at 3.93%. Net NPA ratio is, the highest in last 8 quarters. Now, it's weird to see that net NPA has increased massively given the fact that they have reduced their PCR. So, provision coverage ratio is at 50% versus 59.5% in the previous quarter. It's one of the lowest that you are seeing in last 18 quarters, and this has aided the bottom line. Housing Finance subsidiary has reported a net loss this time around of 27 crores as asset quality woes have weighed in over there. Back to you.
Okay, all right. Thanks a lot for that, Abhishek. Well, let's hop across to Vamakshi. She's here to tell us about BHEL. Hi, Vamakshi. Morning.
Well, good morning, Nigel. When we look at BHEL's numbers, revenue saw an uptick of nearly 32% on a year-on-year basis. This was 4% higher than what the street was penciling in, and this growth was supported by both of their segments, power as well as industry. The gross margins for the company also rose by 1,021 basis points to 37% odd. When we look at the EBITDA margin, that is seeing an improvement of only 25 basis points year-on-year. This has come in nearly 126 basis points below the consensus estimates. EBITDA too seeing an uptick of 41%, but again, there's a miss out here as compared to consensus estimates. Why this miss? And that is because the other expenses saw a substantial jump this time around. The net profit, despite that, nearly tripled, but again, came in below the street's expectations. Overall, the order inflow was quite robust. Order inflow came in at 6,860 crore. This is an uptick of almost 167% on a year-on-year basis. The order book is also looking quite healthy at 1.6 lakh crore. This is an uptick of nearly 47% on a year-on-year basis. When we look at the segment-wise performance as well, that also seems quite healthy. Revenue saw an uptick of 32% for the power segment. EBIT margin also improved by 178 basis points. As far as the industry segment is concerned, the revenue saw an uptick of 33%, and the margins here have improved substantially by 465 basis points to 6.4%. So overall, when we look at the numbers, yes, it's a miss on EBITDA as well as the margin and the net profitability, but that is mainly on account of other expenses. But apart from that, the rest of the results look fine. So my sense is the stock is expected to open higher.
Okay, all right. Thanks a lot for that, Vamakshi. Well, hopping across to Mangalam now. Mangalam, Colgate, not too good?
Well, a feeble set in what is a tough business environment. We've seen that across a lot of the FMCG companies, and Colgate no different as well. The revenues just shy of 1,465 odd crores. The street was working with a number of below 1,500 crores. The EBITDA, as a result of which, was a bigger miss, 454 crores versus expectations of around 475 crores, and the net profit came in at 323 crores versus expectations of 337 crores as well. Even if you look at it year on year, it's just a sub 5% revenue growth, in which the domestic business has actually grown just about 3% odd. We've seen a decline in both the gross margins and the EBITDA margins. The net profit, as a result of which, has declined by about 2% too. Though not all is bad, what's good is that the company's reported mid-single-digit volume growth. That was pretty much in line with what the street was expecting, and there has been positive momentum in the premium portfolio. Though the environment is tough, the company's called out relatively soft demand, particularly in the urban market, and they've also called out heightened competitive landscape. So that's something we'll have to keep an eye out on from a margin standpoint going forward as well. But how much of that is in the price? The stock's down about 30% from the highs, trading at around 45 times, slightly below historic valuations. So opens in the red, but could there be buying at lower levels is something that we'll track.
All right, Mangalam, thank you very much for that. So that's Colgate there. We've got some news coming in at the bottom of the screen. Let me just sort of run through the top 10, then we'll address this at the bottom of the screen. Star Health reported earnings. Yash has got details here. Yash, morning.
Morning, Prashant. So, of course, a weak set as far as Star Health Insurance is concerned for the third quarter. The net premium earned, that's grown at a decent number of about 15%, coming in at about 3,800 crore rupees. But the operational performance has been very weak. Underwriting loss, that has gone to about 49 crore. This compares to an underwriting profit of about 114 crore a year ago in the same quarter. Operating profit, that has come down by about 46%, coming in at about 153 crore rupees. PAT, as a result of which, has also seen a decline of about 26%. Combined ratio, importantly, that has seen a significant correction of about 546 basis points at about 103.28% versus 97.82%. What have been the two reasons for this? The increase in commissions and total expenses. Commissions have increased by about 43%, total expenses increasing by about 21%.
Thank you very much for that. Some more details from the NetWeb press release. One, remember the stock was down 10% yesterday. It's fallen more than 50% from its recent 52-week high. And the street was concerned because NetWeb has a tie-up with NVIDIA where they supply some of the solutions for NVIDIA's GPUs, etc. They use it. So therefore, the street was concerned. And the second reason is the 1.5-year IPO lock-in ended on Monday. This Monday. So there were additional 1 crore shares which were released, and that added to the supply pressure when there was so much negative news flow. So here the company is basically trying to say is that DeepSeek paves the way for the market to expand. So earlier, perhaps there would have been companies which were hesitant to adopt technology because of the high cost of adoption. But now with DeepSeek lowering the entry barriers, reducing the cost, we will see more customers adopting to it, and NetWeb solutions are GPU neutral, which means that they can cater to all companies, whether it's NVIDIA or DeepSeek. So that's the basic crux of it. They go on to say that the company's financials are very robust. In the first 9 months of the year, the company's revenue growth has been in excess of 60%. Their order book stands at 360 crore rupees. Their L1 pipeline is strong. And therefore trying to allay some concerns, but basically, making the point that, these developments, these breakthroughs in AI will only expand the market further, which will benefit NetWeb. A quick recap then of the top stocks to watch. Stocks with positive news flow are Bajaj Auto, MGL, GMR Airports, Suzlon, BHEL. Stocks with negative news flow are JSW Energy, SBI Cards, M&M Financial, Colgate, Palmolive, and Star Health. And from stocks, it's over to Manisha now for a complete roundup of all the action from the commodity market overnight.
Thank you for that, Rima. Well, I'll start with the crude oil prices, where we have seen a percentage point of gains in the overnight market. This is after 8 days of constant decline. Well, U.S. planning to issue tariffs on Canada and Mexico imports this week is what really seems to be supporting markets, because that would mean higher prices. And apart from that, Libya protests have also prevented crude oil that supply disruption premium also is getting in prices. But apart from crude, when you look at metals, this is a very interesting trend because base metal prices have gained in US and have declined on London Metal Exchange. With the import threats and import tariffs on metals like copper, aluminum, etc., there's a lot of buying that is happening in US ahead of these tariffs being imposed. So you have copper premium in US standing at a tall $300 a ton right now, and that's exactly what we've seen in aluminum and zinc and in some sense steel as well. So metals in US are expensive than metals anywhere in the world at this point in time.
Okay, all right. Manisha, thank you very much for that. So that's commodities in focus as always with Manisha. We'll take a quick commercial break here. You'll hear from Pralay Mondal of CSB Bank as we discuss their third quarter numbers and outlook going forward. Stay tuned, that's coming up.